The episode of Beating Alpha. This is episode 118, and we have a very special guest. His name is Scott Choppin. So Scott is the founder of Irvine-Pacific Group and he oversees all the operations of the Irvine-Pacific family of companies, including business development, capital acquisition, and strategic planning. Prior to forming Irvine-Pacific, Scott was director of land acquisition for the multifamily development division of Irvine-based Sares-Regis group. Hopefully, that's the way to say it. In that position, he was responsible for all land acquisition activities for the development of luxury, market rate, and senior rental communities throughout California, Colorado, and Arizona. So before joining Sares-Regis, Scott was with Kaufman and Broad Multi-Housing Group. As a senior project manager, he was responsible for all activities related to multifamily development, including the acquisition, entitlement, syndication, and development of over 1,900 affordable multifamily units throughout the Western United States. So prior to that, Scott was project manager with Irvine-based Snyder Langston Real Estate and Construction Services. So Scott holds a degree in business administration with a specialization in finance from California Polytechnic State University. And of course, you have to make sure that you get in contact with Scott, and all these links for Twitter, LinkedIn, Facebook, Instagram, and the website, of course, urbanpacific.com. So Scott, I appreciate you being today on the show.
Great to be here, Martinez. Appreciate the invite.
Thank you. It's a pleasure. So where do we go? Do we go back to the beginning stages, or we just jump into business? Where do you want to go?
I'm open. I mean, you gave a good background in just like sort of my career arc. So, let's jump into business. You were asking me some good questions on our before we started. So any of those would be great.
Good. Okay. So we're not going to cover kind of prior experience because, again, as I mentioned, the introduction is there and people can read through it again. But can you talk about Irvine-Pacific and what you're currently working on?
Yeah, so Irvine-Pacific is a real estate development company that I founded. So after leaving Sares-Regis Group that you mentioned in 2000, I formed Irvine-Pacific to pursue urban infill housing development. So in other words, we were going to focus on locations that were in the city, right, in city fabric. So we weren't going out to rural or even, suburban areas. We wanted to be as close to job centers and close to the city center as possible, developing either vacant or underutilized assets for different housing types. And so that's really been our objective, this entire 20 years. We're going on 20 years of operations. Wow. And, as that you and I started to talk about, we're focused on, building a specific model and innovation that we created in the workforce housing space called Urban Townhouse. And, we pair that workforce housing model with private capital. So we're a developer which creates new projects and owns those once they're completed. And then obviously as part of that, we raise capital. So we're in the syndication space, and that's sort of the overview of what Irvine-Pacific does.
Got it. And of course, I'm just looking at the numbers. 3,400 units developed. That's in excess of $900 million. So can you talk about, again, why have you chose to kind of pursue the workforce housing instead of building office buildings or something in different than commercial asset class?
Yeah. Well, the way I think of it, Martinez, we really differentiate from just classic standard multifamily. So really, if I were going to say what we've done most of and what we're best at is building apartment communities, right? Residential rental income. We're not office guys, we're not retail guys, we're not self-storage. And those are all great assets, depending on, the time of the market and the location. But, we've always organized around the fact that housing is a fundamental human biological need. People need shelter that will never cease to exist as long as human beings, exist. And so we always look at it as a place of, refuge, right, for human beings to seek shelter. Then the question becomes, what type of shelter do you focus on? And so, really what we do is differentiate between, classic multifamily, think existing apartment assets, value add would be one of the, strategies that, you've talked to with other guests, likely, owning existing, income producing assets. As a real estate developer, our main job is to create new projects, new assets, right? So we don't go buy existing, we create new. And that's interesting because we get to specify what we create, right? Like if there's some new need in the market, we're going to identify it. And really, we've always done urban infill, as I spoke about before, and that's been affordable housing. That's been, standard market rate podium, we call it, which would be, in more recent times, studio and one bedroom product. About 3.5 years ago, we finished up a good, bit of development operations, had a lot of really good projects, sold those, did really well. And then it threw us into a new, domain of thinking. Like the market was really maturing, and like we were in Denver and Southern California, and a lot of new projects were coming online, right? In the development space, you really have to pay attention to what's the supply pipeline, right? And how do you compete in that space? Do you want to compete in that space? And we saw a lot of developers offering the same thing. It was high density or middle density apartments that were studio and one bedrooms, right? Meant to serve millennial and Gen Z populations that were starting to move out of the house or graduate from college. And that's a great space, right? Biggest demographic cohort in US history, but also tons of competition. And really more importantly, like really great competitors. Trammell Crow would be names that people would know, Holland Partners, those kind of guys. And so we've always been somebody who looked to be, innovative, contrarian, uncommon offers. Like, we're not necessarily going to just compete on our cost of capital and our, our financial capacity. We want to be picking places where trends are moving to, not where the trend is, right? And so workforce housing has always been in my background. You mentioned Kaufman and Broad in the introduction, and that was the company that built and syndicated affordable housing projects. And that always gave me really tapped me into the space of working families as a demographic that was really underserved. Really, if you look at it, government subsidized housing can only serve so many families because government money is finite, right? You can never build enough relative to the demand, at least in places like California. And so we started really like thinking about the idea and reflecting on like what part of the market is not really served. And really what we identified is middle income families, right? Working class families that had, need for larger space, more bedrooms, made certain incomes, right? And so the market either is government subsidized on one end, that's low income families. On the other side, you've got your, class A, brand new luxury downtown, sexy studio unit for your, younger professional. And really, we started looking at this. We go like nobody's building in this middle income space. This, in fact, people call it missing middle sometimes. And so we basically, sold off all our entire portfolio of development projects at the time in late 2016, and started basically developing this business plan of UTH. Because we believe in two things fundamentally. One is that this is undersupplied, and being in California will be undersupplied for a long time, right? That gives good, economic, formula, right? Like you want to be delivering, high demand product into low supply marketplaces. But also these families are by themselves inherently more stable because they generally live multi-generationally and they have multiple earners in a household, right? And think of where we are right now in the coronavirus era with people being laid off. If you're a family of 8 or 6 or 8 people and you have 3 or 4 wage earners and you're sharing your incomes and expenses across the family group, and one person loses their job, well, that family stays afloat, right? They're able to survive because they have other incomes, right? They don't lose their entire income. Like if you're in a studio unit and you're the only income earner and you lose your job, you're not going to stay in that unit, or at least you can't, have the long-term capability to. So this workforce housing space is undersupplied and has a very robust, sustainable demographic, right? Like in an environment like this, they batten down the hatches, maybe kids move home, in-laws move in, and our 5-bedroom, 4-bath product really serves that family appropriately and makes for a very stable investment.
Okay. So, I mean, I have so many questions right now, so I'm very gladly that you kind of covered it, a lot in that. But one question that I kind of popped in my head is you mentioned that like the state of California is going to be always undersupplied when it comes to the, like maybe you mentioned is that the workforce housing, maybe properties. I don't know what's, but what makes those people come into the state of California? So, I mean, people are always
Mhm.
going to be looking for property. So why is that? What statistics are you guys looking at?
Yeah. So we're going to really look for two predominant, like sources of that demographic. First and foremost is people that already live here. Now, you and I will talk later about the story of people moving out of California,
Mm-hmm.
and that certainly is an issue. In fact, I think this year, maybe the first year, this census, maybe the first time that California's lost population since 1849, right?
Wow.
But there are always going to be people who basically are from here and their families here and their kids are in school, their life is here, their history is here. And that causes them to figure out ways to how to stay here. And that's really the families that we serve, is those people that are figuring out how to stay in California because they love it. Now, I'm not saying that's everybody, but I also don't say that's nobody, right? It's not like the entire middle class of California is going to move to Texas, and if people move to Texas, I go, great. Like if you can make similar wages and have lower living costs, housing costs, you should do that, right? Like that's an appropriate thing. But we're serving those families that basically decide, they go, look, I do want to live here. My life is here. My family's here. So what we say about these families, they have very strong social networks, right? Jobs close by, kids in school, extended families close by. And the predominance of renter families that come to look at our units actually are from right around the neighborhood where we're building, right? So that's one group. The other group is California will continue to be an immigrant gateway, right? We have been for a long time. Pacific Rim, people who decide that they want to move to California. Now that again will also adjust based on what we spoke about, which is California, I think, will be less and less seen as the mecca for people to move to make their life, right? Like, the sort of the gold rush mentality. Other places are going to be better for that, right? Texas and, other red states that have, better job growth, better cost of living, I think are going to be advantaged over California. But California is such a huge economic engine that I think it will take many, many decades before that shifts enough where that's a factor for us to be worried about an ownership of middle class, housing. And also for relative to both those is, although California is becoming more wage unequal, in other words, we have very wealthy and very poor, like we're starting to become polarized, there's still going to be people who need to live here, who want to live here to work in jobs that do serve the economy. And maybe we could say, serve people who make a lot more money than they. And our housing type allows those people to combine, their economic forces, right? Economic sharing, to come together and, a household of 3 or 5 or 7, and allows them to economically share and stay here. Now, I'm not saying that's the solution for everybody, right? I even say, Martinez, if anybody could go buy a house and afford on a middle class, salary to buy a house, I would say that that's the best thing, right? Like I don't discourage that. I just say the economic realities don't produce that, right? They don't produce the savings to make a down payment. In some cases, they produce the income. Sometimes they don't. So we're giving a relief valve in our product offer to families that decide that they want to stay here for all the reasons that I just described. And then the reality is it's undersupplied in California because our political environment is so detrimental to housing production. There's a reason why we have the highest housing costs in the United States, is because we produce the least per capita of any state in the United States, right? And that's a political issue, meaning state law and local city law and county law really are anti-housing, and they have been for decades, and they will be, from decades from now. Now the environment is changing legally, and I think the state law and the political environment is starting to shift right towards more housing production. But it's going to take decades for us to basically catch up to where we should have been, because we've been decades behind, right, from the previous, low production. That's just a good story of, long-term undersupply. And the reality is, middle class, even when we do catch up in production, it's going to still be predominantly in that affordable housing side of the spectrum and the luxury side of the spectrum, right? Middle income really still is a space that, if you listen to the mainstream media, people go, oh, you can't make that work economically. We have. So we see it as a space to compete.
Got it. So the question on that you mentioned is that the state of California were kind of against building a new buildings. That of course is a lot of people, like, there's homelessness, which is a big problem in the state of California. So can you talk about the zoning? Because I came across a few people who are developers in the state of California, and they build like condominium style apartments, which doesn't take a lot of space, but for you're building these workforce housing, so, and it takes a little bit more acreage. So can you talk about the process, and like, does it take a long time to kind of to pitch your deal in for the state of California, and how the process works?
Yeah, it does. So there's a couple different answers. So we have the most one of the most complicated zoning environments in the United States. Maybe like California and New York would be, neck and neck as far as to complexity, right? And complexity in our business development always causes delay in time, increase in costs, right? Lower capability to develop projects, right? Like in development, you buy a piece of land, you go to the government and you say, I want to build this apartment community. And they, generally they can say yes or no to that, what we call discretionary entitlements, right? So as an operator in California, I've always, basically my entire career has been developing in California. So it is difficult, and many developers do take on the like larger entitlement efforts, right? Like rezone and general plan amendment, EIR, environmental impact report. Those are all California, particularly general plan amendment, EIRs. They're like big deals in California. And they also are the mechanisms that people fight your project when you want to move it forward, and can, in fact, in many cases, kill your project, right? So a developer takes the risk of going to the planning commission or city council, and at the end of the day, they say, no, like, we don't want it politically, we don't want it. And then, maybe lawsuits, ensue, and those kind of things. Very costly to the development community. In fact, a lot of developers just go, look, I just don't even want to do it. Okay. And that means that they just don't work in California,
So
right? I know a lot of people.
Can I just ask you, when you propose those type of deals, is there some solid objections that these people put out, like when they say no, or did you just know?
Sometimes, but many times not. Many times they go, oh, it's going to be too many kids in school. It's going to be too much traffic. It's going to be, in some cases, maybe it's hurting the environment. Maybe there's if you go out to more far out locations, green fields might have, birds and bees and butterflies that would be impacted. That's why we've always stuck with the infill model, because that's going to go in city fabric where there's less likelihood for that to be happening, but then you have more neighbors, right? So the system is designed or defaulted to its design such that really anybody can fight your project, right? For almost any reason at all. And so what that does is that means that, you just have to come up with two or three things. Traffic and school impact are a major, like, roadblocks that people can, throw into. And it doesn't have to be, sensical, Martinez, right? Like, when you get in front of a city council, it becomes political. So like today's environment in the United States, political, people will make up whatever they want on either side of the argument. And it's just a function of who believes what, and can you get 5 or 7 city council people to believe enough to get you a majority vote or not, right? And you just have to convince human beings that this is a good argument or a bad argument, or a good project and a bad project, and then you're subject to that. But let me finish with this point. What that does then for developers like us is that makes us choose land sites that don't require to go through that process, meaning we pick sites that are already zoned, right? Meaning we don't have to go to the planning commission or city council. We do what's called a by right project, which means that the zoning's already in place for our product, right? And we're 22 to the acre, that's our density. And we can fit our style of development into lots of existing zone sites already, which means that we know the entitlement process really well. We come from California. That's what we've done our entire careers. It also says for this business plan, we choose not to do that. We avoid that. Now, occasionally we'll take that on if it's the right land price and it's the right discount or the right risk profile or the right project. But I would say out of every 10 projects, maybe one is going to go through the entitlement process, and the other 9 we want to do by right, which means we skip that process. Like that discretionary entitlements, which means that at their discretion, they can say yes or no. When a site's already zoned, we just go in, we say, here's our plans. It conforms with the zoning, and you can't say no. I mean, yeah, they code check our building and make sure sprinklers and fire egress and parking, all that kind of stuff. There's still input, but they can't say no, right? They can't say no politically, which means for any reason or no reason at all. When you sit in front of a city council, if that 3 out of 5 city council people believe the neighbors more than you that your project's a bad project, they're going to vote against you and you're done. There's no, I mean, yeah, you can do lawsuits and that kind of thing, but how much do you want to, delve into the friction of a project like that versus you just move on, you go next, I don't want to do that one, next, and then you're picking sites that are going to be already set up to be successful.
Yeah, I mean, you're going to be bidding against, the politicians and the people who are in the government. That's a tough war to win sometimes, right?
Well, and right, and so for that reason, you go avoid it.
Yeah.
Then you don't have anybody having to give you that. And I'm making it sound really simple. There's still a lot of friction in the process, but our job as a developer in every aspect of the project, every part of the cycle of going through a project, we're choosing that choice of land or our building style or our locations that lowers complexity and lowers friction. So at the end of the day, we've got an achievable project. It's never, no project's, 0 or 1, right? It's not a binary. It's like, hundreds of choices that you make along the way that lower risk, that lower complexity, and make the project more feasible and achievable. In fact, my saying is complexity is the enemy of profits in the real estate development process. The simpler you can make it, right, the more successful you're going to be, or the higher confidence level you have of delivering a project that's successful generally and achieves yields and is timely, right, is built on time, built on budget, and doesn't miss the market, right? Like as a developer, we have to contend with all those different outside forces. And so what we do is we just shape the design and strategy of our offer to be highest likelihood of success, which means lower complexity, lower friction.
Got it. So can you talk about those projects? I mean, like when it comes to the price of it, cost to build, is it like per square feet, per unit or per project basis? Like how much does it cost?
Yeah. So one of the ways that this model works is it's not one thing. We can't generate market yield on middle income housing like just accidentally. Like one thing helps it. There's actually several things. So some of the stuff I've talked about. So we're buying land in middle income neighborhoods, right? Think blue collar working class neighborhoods. That keeps the cost of the land down. Also, we're finding, sites that are less competed for, better zoning, right? Like we talked about before. We build a 3-story product, basically, which has it at the equilibrium point of, maximum income generation at lowest cost, right? In the development world, you want to generate the most net operating income at the lowest cost, right? In fact, there's a ratio we use, NOI to cost, right? It's how much dollar of NOI do you generate on a dollar of cost of build it. And you want that ratio to be, 5.5, 6, 6.5, 7% or higher if you can get it, right? To meaning that's the spread between your income generation and your cost, structures, right? So, we're building, I'll just give you a range right now. We're building between about 125 and 135 hard costs per square foot. That's all in. So that's all the horizontal. So that's demolition, grading, site utilities, and our vertical, meaning building the building. Right now, in comparison, I think you'll find most people you talk to in California, that's a pretty competitive number, meaning low. And we do it that way on purpose.
And sorry, do you mind me asking, and how is that compared to the other states?
Other states, it's probably going to be high, right? The same reason we have high land costs and high rents and high housing costs is because it also costs most to build. California, the same as the political environment is not conducive to housing, right? Like politically to approve housing also means that the state basically loads all kinds of cost onto your deal. So this year,
sorry, if you don't mind me interrupting.
No.
So if you're going to look at the cost to build versus, like the NOI that the property is going to produce, let's say in the state of Texas, is it going to be returns going to be pretty much the same? Let's say 7-8%, or is it going to be a little bit different?
You know, I haven't tracked. I mean, generally, the answer is this: is that most other states should be lower cost than California from a cost standpoint, but also you will find that the rents in those markets are also lower, right? So that the formula just adjusts obviously to the market, right? It's a market-driven ratio that I'm describing. But I would say generally, you're going to find, in like as we've looked at Texas as an example, you know, you're likely going to have better returns because you got, maybe similar rent levels, but still lower costs in California, but are still at a better ratio than your cost. But the markets adjust, right? Like in other words, in Texas, if you can generate better returns to develop a project in Texas, that means more developers can do more projects because everybody's figured out that the deals work. And so I will go do more deals, right? So the market,
And there's more
well,
deals in
and
Texas.
land in Texas is cheaper and it's easier to zone, right? It's much more user friendly, business friendly. And so the market, will speed up more quickly to capture that spread, right? If your spread in California is this and in Texas is this, well, people are going to do more projects, which means you're going to buy your spread back down, or the development market will catch up. And in fact, in Texas, as people invest in Texas, it's generally say, oh, it's a cash flow game, because appreciation never, grows massively, because as soon as appreciation ticks up, right, values go up, then the development community will do more projects, which brings the returns back down, right? So it will always catch up to itself, right? So you got, low spread, market goes up, and then market, more developers come in and spread goes back down, right? And that's a natural cycle to keep going
And
through that.
would you think that those kind of southeast, southwest states are gonna start to appreciate a little bit more over time once the baby boomers and the rest of the
It depends, but I think generally my point is that in markets that it's easier to develop in, the appreciation will be less because it's easier to develop. So if market goes up in value, the development community will start more projects and drive the returns back down. This is why the Midwest market has, if you go to the Ohio's and the Rust Belt communities, there's a reason why the multifamily markets don't ever appreciate. Is one is they're losing population, but two, there's no demand for nobody's moving into a place to drive rents up and creating more demand for your housing product, right? It just it stays very stable. And in Texas, as an example, and we've researched Texas, there's a lot of people moving in, right? Which means that, population grows, meaning more demand for apartments. But as soon as the market starts to tick up, the development community will start a bunch of new projects and then drive the market prices back down. Like it'll always catch up for itself. So California is opposite, because people move to California and drive up the demand for apartments, but you can't build more as fast as the population grows. And so therefore you just restrain it economically. It's economics 101, right? When demand increases and supply is equal, prices have to go up, right? In Texas, it's demand goes up, but then supply goes up too, right? And then prices will moderate. That's really simple economics. And I'm not trying to make light of what you're saying. But, generally look, as a developer, you want to go where population is increasing, right? That's a better story, where jobs are growing and population's increasing. And places like Texas, that's a good story. So I think from a housing growth and demand generators for your housing, if you're an apartment developer, that's a good story. But you have to be cautious that other competitors will come in and can, build right next to you and drive your rents to remain flat or downwards. That's a question mark, right? Whereas California has this supply restriction, but we also have a demand restriction. People in fact, you said it when we started, people are moving out of California because housing prices are so insane that they go, like, I can't sustain this. I can't live a good life. And so I got to move out of California. And so, we're always sort of trying to figure out where's the right place to make money in that environment. I just come from California, so I know that market best. And I know that politically and legally, the legal environment won't have us catch up in housing supply rapidly. Right, not as rapidly as a place like Texas, where everybody can catch up very quickly because you can start a lot of new projects very quickly, right? Because land is available and zoning is friendly and the cities are user friendly. California, you got to fight for everything, right? So we've been artificially restricting supply for decades now, hence our housing costs are the highest in the United States.
Got it. So for you, if you're going to plan to move in different states, it will be super easy for you to do these projects.
Yeah, you can move there, and it is easier to produce. In fact, you know, part of the reason we used to have a tax office in Austin before the 2008 recession, so we like the Texas market. But it also is, you know, you can't depend on the supply restriction. In fact, you have to orient to the opposite, which is as soon as the market starts to appreciate or rents start to appreciate or both, then you got to look for, you know, people to come into the marketplace and start building more. So I'm not convinced that a place like Texas or the Southeast that will be more development friendly is necessarily the place that we want to operate yet, if only to contrast to our UTH model in California, because we figured out a niche that in California works really well, right? Given the difference between housing costs and incomes, right? Like we're going to travel in the space in between those. But look, the market may change, right? You know, if you know, development community catches up and we get a lot of competition in our space, then our model will cease to work as well. I just don't think in our environment presently that, you know, we build a 5-bedroom, 4-bath townhouse rental unit. That's our unit type, that a lot of people are going to jump into that space. It's so different and so contrarian and so uncommon that I expect it to take more time for people to catch up, but people will, right? And so we have to be in the conversation of continuous innovation. And we need to always be looking for yes, we created great innovation. We captured a lot of economic benefit. We served a lot of families really well. We produce yield to investors, but I can't sit here and say that's forever. In fact, I say right now, it's not forever. Somebody will catch up. Something will change. The market will change relative to our product offer. And then the economic, you know, engine of that UTH model will be less. But the reality is, you know, supply constraint is our biggest friend right now. And I don't see that catching up like instantaneously or quickly at all. It's going to take decades for us to catch up for that.
Got it. So coming back for your own personal properties that you guys are building, like what type of approach are you using when it comes to the leasing those properties? I mean, do you have like a kind of vertically integrated management, property management, or you know, like use a third party? How do you go about
Yeah.
that?
The great question. So we actually do both. And so on larger projects, so let's say any project that's over 30 units, you know, our development pipeline right now on bigger projects ranges between 30 to 100 units, right? For these UTH projects. Anything less than 30, then the metrics start to change and hiring a third-party manager. And so we'll manage those in-house. And so we actually have several small mid-sized projects that we're developing now. In the coronavirus era, we're in the story of developing nimble projects, right? Like small, mid-size, easy to execute, quick to construct, quicker to lease up. And we just want to do several of those. All those will roll into our in-house property management team. In fact, we just brought on head of property management, Eric Christopher. He came on a few months ago to basically run, you know, all of our internal property management offers and then oversee asset management when we do use third parties. But we do that as an efficiency model, right? So 15 or 20 or 30 unit project is going to be less efficient for a third party to manage. Therefore, they have to charge more as a percentage of gross income. And so we've formulated a internal strategy to offset that. Like we can operate a lower, more efficient costs on those small projects just because we know we're going to build our pipeline of those deals and have more of those to add to the portfolio in the future. Plus, you know, the reality of managing, you know, a project that has predominantly 5-bedroom, 4-bath family occupants or tenants is a different economic, you know, undertaking and a different property management strategy. And I don't think a lot of third parties are like necessarily up to the task of that. Really, it's almost more like managing, in fact, it really is managing a type of affordable housing. And because we have that background and already the teams in place that we're taking that on. And we're vertically integrated anywhere we can. So all of our construction operations are all run in-house. So we don't use third-party general contractors. We're more what I call the home builder model, which is, you know, our development entity basically contracts directly with the subcontract markets. So we eliminate that middleman, also keep more control in-house, better cost control, better change order management, you know, better, you know, design management in the context of delivering projects, you know, on time, on budget. We've been doing that since 2005. As a rule, we'll build everything in-house and have, great set of subcontractor partners. That adds a lot of efficiency to our, to our economic model also.
Got it. Got it. Awesome. Good. So one thing that I wanted to ask again, when it comes to those development projects, like you mentioned before, that you're accepting other people to invest with you in those deals. So can you talk about how those deals are structured?
Sure. Yeah, I think, so yeah, we're regularly speaking with, high net worth and family offices about investing in our workforce housing model. We're getting good, workforce housing as an idea, Martinez, is very attractive to people because we know that we know, and the market knows that the demand characteristics for that in the future is like, rising demand, meaning more and more families need this type of housing. And there's, again, restricted supply. Even outside of California, there's still not enough affordable housing, right? Ours is middle income housing, so we're a little bit different formula, but still we fit into that, making housing more affordable, whether artificially, government subsidy, or naturally versus structures like ours. So basically, a couple different answers. So in the early cycle of UTH, going back about 3.5 years ago, we did 4 projects in what we call the demonstration phase. We wanted to prove the model worked because really nobody's doing 5-bedroom, 4-bath townhouse rental units at scale, right? So it's totally unknown. We needed to test it. We've proven that model in the first 3 projects in that portfolio. We built, rent, and sold. So we did a merchant build style. And on that portfolio and those sales, we generated 22.6% internal rate of return to our outside investors, to our, in our syndication structures. So, very good, returns relative, to the timelines and the stability of the housing type. Then about 2 years ago, we decided to convert everything on a go-forward basis to long-term hold. Basically for 2 reasons. One is, like you and I spoke about before, we believe in the product so much and the undersupply story and the social impact to these families that we want to own everything that we build really, in perpetuity. So we raise capital now generally on a 10-year hold basis. But also that 10-year hold 2 years ago puts us in a patient position relative to recession, right? So a recession finally came, right, in 2020. And in a recession in California, because we're undersupplied and we have a stable tenant base, right, these middle income families that are economic, sharing, we can tell a story of stability in the rental production in these units, right? If we didn't say we're agnostic to the value changes in a recession, like we don't have to sell, and we have stable tenants and stable income from, stable NOI from tenants that are sticking around to rent in our units, then we can say we can be patient through the downturn and then get to the other side of that recession and recover and maintain stability and values, right? If we look at California in the 2008 recession, I mean, the valuations of multifamily barely budged, right? And that was because a lot of people were going into the rental market, like making that rental market stable. Of course, coronavirus recession is going to be a different recession, but it appears that, multifamily housing, and particularly our housing type where people leave new housing and studio and 1-bedrooms, they go into our 5-bedroom product to, share with families and roommates. We're a product that receives tenants moving from other places and they come and move into our product. In fact, we're already seeing that now. So we call it recession resilient, right? So right now in a long-term hold, we're looking at 18 to 20% internal rates of return on a 10-year hold basis. And, people need to overlay that, yes, that's a competitive, or at least we believe it's a competitive, even markets for a yield for new construction. But really, I encourage people to focus on the stability of the product, right? Like you want to make an investment in a product that is going to continue to be in demand, that's in a long-term demand arc, undersupply, high demand type of location. And that's where a place like, Texas is great. But if several developers come next to you to develop right next to your brand new deal in Austin, that's going to take the wind out of your sails, or maybe cause you to lower rents. Where in California, that undersupply story really makes it like, it's like Warren Buffett says, it's like you build a moat around your company. That means the economic offer of the company is defensive, right? Like people can't attack you. You got a moat protecting you. Well, workforce housing in California has a moat around it, which means that politically it's hard to build enough new units. we're a very unusual offer, so a lot of people aren't going to compete in our space. So we have a economic moat, right, in the Warren Buffett style around us. So not only are we delivering, really good returns, but we have a really stable, defensive economic model for the housing to sustain its value over that long-term period, right? If you're thinking out 5 or 10 years, you got to go, what's the housing market look like in California in 10 years? Are we going to produce so much new housing that your housing is going to go down in value massively? The answer generally is no, because our political environment restricts housing, and it's going to, increase a little bit here in the next few years given new laws. But the reality is the political environment, right? People who live in California generally, and I'm generalizing, don't want more new housing. Single family homeowners in various cities don't want more apartments next to it or in their city. So they're fighting it constantly. And I don't think that's a good thing, right? It's causing the homelessness that we have. It's causing the economic strain on middle income families. We just say our offer resolves that question for those families, allowing them to live stably in this environment if they choose to do that. And so that's a good story on a really long-term basis.
So another question that I have, developers like yourself or multifamily syndicators, they focus a lot on one process is raising money. And we spoke about it a little bit before we started recording. So one of the ways is, as you know yourself, raising money from private, people, from limited partners. And some of the, that's one of the ways that they invest. Some of the, crowdfunding platforms, those are available. But you mentioned something a little bit different, which I would like for you to kind of talk a little bit more, is tokenized equity. So we can maybe talk a little bit more about kind of that process and why you're looking to imply that also.
Absolutely. So, I'll sort of give a little bit of background for, any investors who, don't know about crowdfunding or tokenization. That's even more cutting edge. But if you think of it generally, like most, historical syndications would be, you form a new legal entity, maybe an LLC. You then share, sell membership shares to outside investors who bring capital into the entity for the long-term economic benefit of the ownership of that LLC and multifamily investment assets, right? So, call it the, historic syndication model. Crowdfunding is literally that same model. In fact, you have LLCs, and you're going to do SEC registered crowdfunding raises. Like we're doing a deal now on a platform called Small Change, raising our equity for our 1491 Atlantic deal, and that's a LLC structure, raising capital from outside investors. We just happen to be channeling the information and the capability for people to find and invest in our deal through the crowdfunding platform, where they can go on a website, sign up for membership there at Small Change, invest their equity through that structure, and then it flows into the deal, right? And then tokenization is sort of the next step, which is very cutting edge. So, if people know about blockchain, know about cryptocurrency. So this is a blockchain-based equity investment, right? Where it's still, but here's the thing, it still uses the classic LLC structure. It still uses the, sale of shares of an entity for trade of capital. Tokenization now is just a different vehicle for trading the ownership and the capital that happens in all syndication transactions, right? Investors giving capital to the syndicator and receiving membership shares back for the economic benefit of that deal in the future. Tokenization now just puts that transaction on the blockchain, right? So it tracks it immutably, right? Like we can't, erase the evidence of that transaction. And what you get instead of a paper share, or if you sold, like if you gave a classic syndicator equity, he would give you maybe a paper share, some evidence in writing that here's your membership of this LLC or that LLC. Tokenization just grants you that membership via an electronic, a digital token, right? So a lot of the new, digital syndicators, digital tokenization companies base the membership share on an Ethereum token. Ethereum is being, a version of cryptocurrency, and Ethereum is used more often than, say, Bitcoin to actually deliver financial services. So it is a cryptocurrency and does trade, but it's also a vehicle for tracking financial transactions between parties based on the blockchain ledger, right? So ultimately what you're doing as a syndicator is you're selling digital tokens of the membership of that legal entity, sanctioned generally by the SEC, And that's one of the things to think about as people like, people may have heard of the ICO, which is an initial coin offering, which was the, version 1.0 of selling equity in projects or businesses. You did it versus this coin offering, right? Very Wild West, no sanctioning bodies. You could like issue ICOs from any place in the world. Very murky in my experience. In fact, we could never get comfortable with it because it just didn't have enough legal structure around it for us to really feel comfortable about it. But this new version, STO or security token offering, is based on these, like the Ethereum token, and also registered or sanctioned by the SEC under either Reg CF or 506C or 506D. Maybe some people are doing 506A, right? And these are, sort of based on historical legal structures sanctioned by the SEC, but they're tokenized digitally, right? And as you and I spoke about, before we started this interview, I'm very bullish on this because, like, the reality is, the methods of raising capital are going digital. It's going to happen. It's already happening. It's just we're in the early adoption phase. Crowdfunding is a earlier version of that, but crowdfunding basically is syndicating via a web platform, right? Via somebody's web application, their web platform, their web marketing. The marketing is digital. The transacting of the money is digital vis-a-vis these websites, right? Or these web apps and web channels, right? Internet based, right? Tokenization now is adding that web marketing, that internet marketing channel, still a platform, still a website, still a web app, except now you're transacting for a digital token. And that is basically the evidence of your membership purchase. The shares of that LLC are tracked on the blockchain, which ostensibly means they're built into the blockchain immutably. Immutably means can't be changed, can't be hacked, right? Decentralized finance, DeFi, as people who do research on this will tell you about. But the thing I'm really loving about the idea of STO, and we're just delving into this now, we haven't even closed our first deal board conversation with several companies about, doing these STOs for our projects, is that this basically allows us to have the broadest reach for capital for high net worth and family offices. We can basically go global with this, right? Yeah. So the example I use, if somebody has $500 and they're based in Sweden and they want to invest in California-based multifamily workforce housing like UTH, well, normally $500 isn't enough to invest through a normal syndication. It's hard to transact $500. Crowdfunding sort of does that, but the overseas, when you do a Reg S offer, allows me now to offer the capability to buy, to syndicate this globally. And so now then it also drops the cost of transaction enough via the token offering that $500 can now be available for us to invest, and the cost to the investor of time, energy, money is low enough where it makes sense for them to, invest that capital in our project. So, and then that is like that's the deep future, right, of raising capital for any business, be it real estate, be it, if you're VC, be it, if you're raising company, capital for your company, right? Just, as a sale of shares, even the public, equities markets, right, are eventually going to move into that where, everything will be based on the blockchain. It will be, transacted digitally. Now, stocks are transacted digitally. It's just, they're not, they're sanctioned by the New York Stock Exchange or whatever, NASDAQ, that, that's the market maker sanctioning body that they make the market to trade. Blockchain and these ledgers and these exchanges and these companies, open up a vast arrays of the market that are outside the New York Stock Exchange and Wall Street, right? Which basically decentralizes the capability to trade securities for anything, for companies, for real estate, for ownership of, you could sell shares in your car if you wanted to, right? If somebody's willing to transact for that, and you could produce an economic model that had sense for people to invest in that, you could tokenize a car ownership, fractionalized, ownership interest. So we're, naturally early adopters of technology. We're always looking to use new technological tools that advance, our real estate projects. And, real estate's a super old school business, right? Mm-hmm. We're decades behind other industries in the adoption of these these new technological tools and, internet and computers using for these things. But, like me personally, and my standard of conduct and how I run the company is we want to be exploiting these, new technologies, the maximum effectiveness now.
Got it, got it. And I love it. I love the fact again, because you're taking same approach, kind of looking ahead as you looked in the state of California. And when it comes to workforce housing, you looked ahead and you just look what's missing, and you did that.
Mhm.
Now you're kind of doing the same with the technology. Well, a lot of people still, doing the old school type of way when it comes to raising money. They jumping
Right.
on Zoom calls, or still going, in a coffee shops with the masks on, having one-to-one
Yeah.
conversations. You're
Yeah.
raising money from people in Japan.
Hmm.
So
That's right.
that's a great way. So one of the things that I want to mention, because when I went to the website smallchange.co, actually you
Right.
just came up, so we can find you can find that it's 1491 Atlantic, and you can go and check it out, the project and what Scott
Yep.
is offering over there. So one question, kind of the last question that I have for you is, again, you're doing a lot of great stuff, and we spoke about kind of before the interview about some transitions and the moves that you're planning to do in the future.
Hmm.
But what is the Urban Pacific future like? What is the goal for this year, for maybe for upcoming year?
Yeah. So, I think I sort of mentioned it passing, Martinez, we're fully focused on this workforce housing model. Like, we don't do any other kind of projects. I mean, we used to do other, serve other types of, market demand in the multifamily development space. I mean, we're always the developer, but we're fully focused on this workforce housing space. So in the long run, we want to build a portfolio of about 5,000 units of this UTH space over the next 10 years. So that throws us into, building, practices, actions that we're in, making offers for new projects and capital to produce 500 units a year. And then really, ostensibly hold that portfolio in perpetuity, right? Like I spoke about a 10-year investment window. We do that because we know people, they're not going to invest forever like that. Just nobody's oriented around that. But for us, we're always going to mechanistically build the LLC structures so that we can, produce yields to investors, but continue to hold, for the company and, for my family as, as part of our legacy in the long run. And then really it's just to get the message out in the marketplace that, that this, like a lot of the work I do is having conversations with like folks like yourself to talk about that there is a middle income model that is economically viable, that does produce yield. And I think that's one of the things that's very counterintuitive, right? People, if you listen to most of the, talking heads on TV and in the real estate space, they'll go, oh, there's no way to make money in this space. You can't make money in affordable housing without like government subsidy or having some restriction on profit. And I'm here to tell you, not only can you, we've proven it, right? That's why we did the demonstration model. So we're continuing to get the word out into the marketplace and really be an offer to investors of like, look, you can invest in this very stable, long-term undersupplied asset, but also it has a good social impact, right? You can help families live a better life. In fact, that's probably becoming, not quite equal. We have to focus on producing yield to our investors, but I'm telling you, man, social impact and taking care of these families and helping them live a good life is like a really, really close second. In fact, at some point here in not too distant future, like I think that social impact will become more important than the yield. But nonetheless, we still have to track capital. The innovation is pairing private capital with workforce housing, so we'll never forget that, right? That will always be, the core of our offer of producing value to investors, but alongside having this great social impact story. So that's really our future, right? I basically say internally and externally that I'll spend the rest of my career personally, as the founder and CEO of Urban Pacific, pursuing this model because I believe in it so much. I know the undersupply is giant, and there's a lot of families that are benefiting every time somebody moves into our units. I'm super grateful to be able to produce a new life. Like I even spent time like what's the change for this family to have this now, that grandmother can live with them and in-laws and kids can move home and they can live affordably. In fact, I'll finish with this, the poverty rates of multi-generational families, that's what our families who live in our units are, multi-generational. They have some of the lowest poverty rates of any demographic in California and the United States. that's a huge factor in the context of, what we're delivering. That's what we're basically delivering in many cases, is because people can live together in economic share, we're giving them the chance to stay out of or get out of poverty. That's a huge deal.
Yeah, that's beautiful. So again, I love the fact what you're doing with the business, and you're helping a lot of people to kind of protect and hedge against the inflation,
Mhm.
against the economy, against the stock market, all these different things. So you help a lot of investors that invest with you. But what's most even important to that, that you're helping the communities, as you mentioned. So
Yeah.
providing them affordable housing, which is really great. So again, you have to make sure you get in contact with Scott. And again, all these links are going to be down below for Twitter, LinkedIn. I mean, he provided me all these different links. So urbanpacific.com, that's probably the main one. And of
Right.
course, the other one that I mentioned for the platform where you can invest. So make sure, again, that you follow, what Scott does. Like it makes a lot of sense, which is talking about what's happening in California. And, like there is undersupply. And, so anybody who's watching and you got some blockchain, you got some equity, make sure to get in contact with Scott and, invest in real estate, because real estate was something that people trusted 100 years before. And, particularly now when there's a lot of uncertainty and people don't know what's going to happen with their jobs and, with the businesses, investing a little bit of that, free money, in something that's solid and provide really great, investment, which is real estate, definitely worth it. So,
Hey, Martinez, I got a quick offer for your listeners. So everybody email me at Choppin, Choppin at urbanpacific.com. That's my email address. And I have an ebook called How to Survive and Thrive in a Recession, which I think is a good timely, piece of knowledge, piece of information. So first 10 people that email me will get this ebook for free. And be happy to have people reach out to me, via email and through the website, as you mentioned.
Beautiful, beautiful. So again, Scott, I really appreciate you being today on episode and bringing all this value and the knowledge on what's happening in the state of California. So it's awesome. I really thank you for your time.
Yeah. Thanks,
Guys,
Martinez. Appreciate the opportunity.
That's no problem. Guys and girls, just one thing that I wanted to ask you before we're going to go. If you share this episode with a friend of yours who always talks about real estate and investing but never pulls the trigger, I think this episode will provide a lot of value, information, inspiration, whatever this person is looking for when it comes to investing in real estate. So make sure to pass it along. Again, Scott, I appreciate you being today on the show. And as always, I'll see you in the next episode. Thanks for watching.